What a wild ride! The energy on Wall Street was electric, with traders and investors riding a wave of anticipation and excitement as the day began. On October 29, 2025, the Dow flirted with a record high, sending a buzz through the financial world. But by the closing bell, that optimism faded, and the index slipped into the red, leaving many stunned. The S&P 500 finished the day almost exactly where it started, barely moving an inch, while only the Nasdaq managed to eke out a small gain, defying the broader market's uncertainty. But the real drama hit after hours. Futures for all three indexes dropped sharply, catching even seasoned investors off guard and setting the stage for a tense night. Why? A perfect storm of news. The Fed's big interest rate announcement, major tech earnings, and updates from other big companies all landed at once, creating a whirlwind of uncertainty. The market was hit with a flood of critical data, and what started as optimism quickly turned to caution as investors tried to make sense of the new information. Futures are the market's gut reaction, and last night, that gut said, "Be careful." The sudden drop was a clear warning sign that uncertainty was taking over. This is the volatility you have to expect. One moment, hope. The next, a reality check. Emotions can swing wildly in just a few hours. It was a masterclass in how quickly sentiment can shift, with fortunes and moods changing in the blink of an eye. So, what spooked the bulls and brought out the bears? The answer lies in the details of the day's biggest headlines. Let's break down the three big shocks that rocked Wall Street. Buckle up, because the story is just getting started. First up, the Federal Reserve. All eyes were on the central bank this week, as investors and analysts waited anxiously for its next move. On Wednesday, the Fed cut its main interest rate by a quarter point. Good news, right? The move was widely expected, and for a moment, it seemed like Wall Street could breathe a sigh of relief. But then Chairman Powell's press conference changed the mood. The optimism in the room quickly faded as he began to speak. He made it clear, another rate cut in December is far from it. In other words, don't count on more help from the Fed anytime soon. That phrase alone sent a chill through Wall Street. Traders who had been betting on more cuts suddenly had to rethink their strategies. The market had already assumed more cuts were coming to keep the economy humming. Investors were hoping for a steady stream of support to keep growth on track. Powell's caution created uncertainty, and markets hate uncertainty. When the path forward isn't clear, volatility tends to spike. If the Fed stops cutting, borrowing stays expensive, and growth could slow. That's a real concern for businesses and consumers alike. The Fed is signaling, don't expect easy money. The era of cheap borrowing may be coming to an end, at least for now. Now the pressure is on earnings and global events to keep the market afloat. Investors will be watching every headline and quarterly report for clues about what's next. The training wheels might be coming off sooner than investors hoped. Without the Fed's steady hand, the market could be in for a bumpier ride. That's why the market got nervous. Uncertainty and caution are now the name of the game. Let's see how the tech giants fared in this new, more uncertain environment. Big tech earnings took center stage. Alphabet, Google, soared 6% after hours, crushing expectations on cloud and ad revenue. But Meta platforms, despite strong numbers, dropped 8%. Why? A massive $16 billion charge from new tax laws and higher spending on the metaverse and AI. Investors worried about profits. Then Microsoft, the AI darling, revealed its OpenAI partnership cost $3.1 billion in one quarter. The stock fell 4%. The message: AI is expensive, and the payoff isn't here yet. One winner, two with costly surprises. Investors were left uneasy. Even the biggest tech names aren't immune to risk. The mixed results only added to the market's anxiety. When tech stumbles, the whole market feels it. But it wasn't just tech flashing warning signs. Main Street just sent its own warning shot, a signal that's hard to ignore. Chipotle's stock plunged 15% after missing revenue and cutting its sales forecast for the third time in a row. The company, once a symbol of affordable dining, is now feeling the pinch as customers pull back. Fewer people are eating out, even at places known for being budget-friendly. Empty tables are becoming a common sight, not just at fancy restaurants but at fast food chains too. That's a red flag for the consumer, and it's starting to show up everywhere. from grocery aisles to takeout counters. Over in Vegas, MGM Resorts tumbled 6% after reporting weak profits and fewer visitors. Even the city that never sleeps is feeling the slowdown. Both stories point to consumer stress. People are tightening their belts, watching every dollar, and rethinking what's truly essential. When fast food joints and casinos start to struggle, it's a clear sign the economic slowdown is hitting home for millions of Americans. These aren't just numbers on a spreadsheet, they're real signals about the health and confidence of the American consumer. If spending keeps dropping, the market's correction could get even worse, with ripple effects across the economy. Wall Street's obsessed with AI and tech stocks, but Main Street's pain is real, and it's spreading. The Fed's rate hikes may be biting harder than anyone expected, squeezing wallets and raising anxiety. And that's making investors everywhere more nervous than ever about what comes next. So, what's next? All eyes are on a high-stakes meeting between President Trump and China's President Xi. A positive outcome could calm markets, a negative one could spark more selling. Geopolitics matter, trade wars and tariffs hit profits and portfolios. Experts are split. Some see more Fed cuts if tech delivers. Others warn October's volatility could mean big risks or big opportunities. The lesson? Don't panic, stay informed. The market is a battlefield of competing stories. Fed caution, tech uncertainty, consumer weakness, and global risks. Your job: listen, learn, and look for opportunity. The last 24 hours prove you have to stay engaged. There's always a bull market somewhere.